Hammer candles are great and often precede major rallies, as you can see in these examples. But what about the occasions when the hammers fail? Can we turn these failures to our advantage and trade it short? The answer, of course, is yes, we can, and there are very specific ways to do that. Hello, I'm Fawad Razaqzada, market analyst with Think Markets, and this video is part of our series on trading the failure of candle patterns. When a genuine hammer candle is formed, what it typically suggests is that price wants to push higher. So what you want to see is for price to make a steady progress, holding above the hammerhead and create interim higher highs and higher lows before pushing further higher. But if price refuses to do that and goes back inside its prior ranges, then that's when the buyers could get in trouble, as the lack of follow through above the hammerhead suggests demand for the underlying asset was not there to trigger fresh buying on the next session. The failure of the hammer is more common when it is formed inside a larger downtrend than an uptrend. In downtrends, you'll get lots of false positive signals, but most of the time they fail as the dominant force is provided by the sellers. The failure of the hammer, especially in a downtrend, can sometimes be anticipated. First, are there any correlating markets breaking lower? For example, the euro dollar may have already broken its corresponding hammer low, but the pound dollar hasn't. In this case, the latter is likely to do so next, as the dollar is already on the rise against the euro. Secondly, how price behaves after a hammer candle is formed also gives us good clues about what might happen next. For example, if price refuses to show bullish characteristics on the lower time frames despite the hammer candle in the previous day, then you can expect a breakdown. Now, the beauty of trading the failure of a hammer candle is this. First, you are trading within the existing direction of the trend, which means you are automatically giving yourself a better chance of making a successful trade than when going against the trend. More to the point, when a hammer fails, this can lead to a sharp continuation lower. The interim fall signal, that is the hammer, encourages many people to go long, thinking that the low might be in. They will go long and place their stop loss orders just below the low of the hammer that was created. As lots of sell stop orders accumulate below the hammer low, this means that in the event of a failure of price going higher, the move to the downside could be explosive as a cluster of sell stop orders get triggered. This means that the potential downside could be significant in relation to where your stop loss order would be resting, which would be a tight one just above the high of the hammer that was rejected. So let's now look at an example of what I've just discussed on actual charts to see how we turn theory into practice. And here the dollar CAD shows a hammer-like candle on the daily chart. Some traders would see this and think that the market has potentially bottomed out, given that price has now formed a higher low relative to this low, which had led to a nice rebound in the past. So when price forms a hammer-like candle here, some traders would think that this could signal the point of origin of the next move up, and they would go long, placing a tight stop loss just below the low of the hammer. But the longer term trend is bearish, with price making lower lows and lower highs. That is why such setups typically don't work in the bull's favor. With this mindset, actively looking for the failure of the hammer could put you miles ahead of everyone else who would look to go long on the back of this apparent bull signal. This is you thinking outside the box, something which I keep banging on about in these videos. So how would you trade this? Well, look for price to break the hammerhead on the next session, and then on the lower time frames, see if price wants to go back below the level and inside the prior day's range. If this happens, then you know that the bulls who bought the breakout are already in a spot of bother. So use this to your advantage. In this case, price climbed above the high of that hammer candle and it was rejected almost immediately, as can be seen by the wick of this candle. Lo and behold, on the next session, price went on to take out liquidity, that is the seller stops from trapped bulls resting below the low of the hammer candle, and your short trade would have thus hit its target. This is obviously in hindsight, but if this was live price action, you wouldn't have known where price would turn lower from, which is why you need to zoom into the intraday charts to look for a precise entry area or areas. So on the hourly, this section shows price that unfolded on the day when the dollar CAD had formed that daily hammer candle. This right here is the high of the hammer, and what we want to see is for price to go above it, trap the bulls, and then go back below before looking for a short trade entry. As I zoom in, you can see that price continually refused to stay above that level and provided you many opportunities to get short. The turning point was right here when price formed a lower low beneath this low, thus breaking the short-term price structure of higher lows. After this point, selling the short-term rallies back into resistance would make sense. However, if you wanted extra confirmation, then you got it right here when price broke this trend line and started to break down more aggressively. So you could have traded the break of the trend line or traded the rounded retest of this level here, here, or here. Regardless of how you got on board, your stop loss would have been somewhere above the head of the previous day's hammer, such as above this hourly candle, which led to the initial breakdown, or above the recent highs here to avoid the possibility of being prematurely taken out of your position. It is important that you get short as close to your stop loss as possible in order to maximize your potential reward, with the target being just a few pips or points below the hammer candle low, where trapped long stop orders would be resting. In this case, that level was hit here before price started to bounce again. Now this is a very simple concept, but very effective at the same time if you trade it correctly. So coming back to our slide and to conclude this video, trading the failure of candle patterns is an alternative way to engage with the markets than relying on traditional way of going about the business. This way of trading is often overlooked by analysts and newer traders, but can provide a strong follow-through, especially when used in the direction of the prevailing trend. Trading candle and other technical pattern failures often provide you with a strong idea where price is heading to, in most cases above or below where trapped traders' stop loss orders would be resting. However, it does require some thinking outside the box, and in this series my aim is to get that across to hopefully pass on some of the knowledge I have acquired over the years. If you found this video useful, please like and share, as this will encourage us to provide more content like this. Also, if you haven't already done so, please make sure you subscribe to our YouTube channel. See you on the next video.